I made over $2 million trading the Forex markets. So when I tell people that I am slowly switching my focus to the futures market, the first reaction I usually get is confusion. They ask me things like, why would you leave the Forex markets if it's working? Is Forex dead? Are futures better? And the truth is, this wasn't a sudden switch. It wasn't emotional, and it definitely wasn't because Forex just stopped working. It was a strategic decision based on how the markets evolved, how prop firms evolved, and how I wanted my trading career to look long term. So in this video, I want to explain exactly why I made that shift, what changed, and what most traders don't understand when they compare Forex and futures. Let me be clear about something first. Forex absolutely works. I built my career trading the Forex markets. I learned discipline there, I learned risk management, and I made serious money trading the Forex markets. So this is not a Forex is bad video. I'm not here to trash the market that gave me everything. But over time, I started to notice some limitations, not in the market itself, but in how Forex is traded by retail traders and prop firms. Things like broker inconsistencies. I'd see a price on one broker that was different on another. Sometimes by a few pips, sometimes by enough to trigger a stop loss on one platform but not the other. Different price feeds, your broker might use their own liquidity provider, and that means your charts don't always match someone else's charts, which becomes a problem when you're trying to backtest or compare results. You also get slippage during high volatility. I can't tell you how many times I've taken a loss bigger than planned because of slippage during news events. Let's say you want to take a sell on your USD, you're most likely gonna get filled and slipped 3, 4, 5 pips below your entry price. And now your risk just doubled, widening spreads at the worst possible moments. During news, during rollover, during low liquidity hours, spreads can go from 0.5 pips to even 5 pips in seconds. And if you're trading with tight stops, that destroys your edge. When you're trading a small account, these things don't seem like a big deal. You just accept them as part of the game. But when you start managing multiple six-figure accounts, that matters a lot. Because a 3 pip difference in slippage on a 200k account, you may get slipped like $600 just by entering the trade. If that happens twice a week, you're basically losing $1,200 from that account for no reason other than the broker or prop firm. That's when I started questioning if Forex was the best environment for me long term. Now this next thing is gonna be a big one. Prop firms completely changed how I evaluate markets. When I started trading Forex prop firms, I noticed something. The rules weren't standard, different drawdown calculation, different lot size restrictions, different definitions of what counts as a violation. And that created a lot of uncertainty. That's what I noticed with Forex prop firms. More rule variations. One firm calculates drawdown from balance, another from equity, another from initial balance. So you have to remember which firm uses which method and adjust your risk accordingly. More subjective violations. I've had trades flagged as high frequency trading when I just took 2 trades in an hour. I've had accounts closed for gambling behavior when I took a legitimate setup during news. And the worst part about it, there's no appeal process. If they decide you violated a rule, you're done. More certainty around execution. Some Forex prop firms don't let you trade during news, for example, or even news that are basically just a long speech. You can't enter before, during, or after the speech. Some prop firms allow you to, but the spreads widen so much it's really not worth it. Some have simulated fills that don't match real market conditions. And when you're trading large fund accounts, uncertainty is the enemy. I don't want to guess if a spread spike will take me out, if new slippage will break a rule I didn't know existed, if my broker feed is acceptable to the prop firm's risk team. I want clarity. I want to know that if I follow my plan, the only variable is the market, not the infrastructure. And that's when futures started to make a lot more sense. When I started trading futures more seriously, the biggest difference I felt wasn't profitability, it was the structure. One exchange. If you're trading ES, NQ, YM, they all trade on the CME exchange. Everyone's looking at the same exact data. There's no my broker versus your broker, it's all centralized data. Every single tick is recorded, every price is the same for everyone. There's no debate about whether a level was hit or not, just transparent volume. In the Forex markets, volume is just tick volume. It doesn't show you the actual transactions. In futures, you see real volume. You can see where institutions are buying and selling, and that's an actual edge. Clear contract specifications. ES has a contract size of $50 per point, NQ has $20 per point. It's all standard. There's no guessing, no hidden fees, no spread manipulation. And there's no debate about price. If ES hit 4,500, everyone saw 4,500. No different feeds, no my platform shows 4,499.75 and yours shows 4,500.25. What you see is what everyone sees. That alone removes a massive layer of stress. And when you're trading for consistency and not adrenaline, that matters more than people realize. Because now I'm not worried about execution anymore. I'm not worried about spreads. I'm not worried about slippage. I'm just focused on reading the market and following my plan. And that mental clarity is worth more than any strategy. Now here's something that most people get wrong. I didn't switch to futures to make more money. I switched to reduce friction. Every time I had to worry about broker execution, that's mental energy I'm not using to trade well. Every time I questioned if a spread spike was normal or not, that's stress I don't really need. Futures removed that friction. It increases my clarity. I want to know exactly what I'm working with. The exact contract sizes, the exact commissions, the exact fields, no hidden variables. At this stage in my career, I care more about staying consistent, not chasing big wins, not gambling, and just showing up every single day and executing my plan. And that's all reducing mental load. The less I have to think about infrastructure, the more I can focus on trading. Scaling safely, I can manage multiple futures accounts without worrying about broker differences. At the moment, I'm trade copying more than 40 accounts and the feels I get are usually the exact same. And futures just fit that goal better for me. That doesn't mean they're better for everyone. It means they align better with where I am right now. If you're still building your edge, Forex might be perfect for you. If you're trying to scale and protect what you've built, futures might make more sense. It's not about which market is better, it's about which market fits your current stage. Now let me say this clearly. The market you trade matters far less than your risk management. You can trade Forex, futures, stocks, crypto, doesn't matter. If you're risking 10% per trade, you'll blow up your account. Your discipline is also important. If you can't follow your rules in the Forex markets, you won't follow them in the futures market. The market doesn't fix bad habits. Again, what matters is your ability to execute consistently. Consistency comes from you, not the instrument you're trading. I've seen traders fail in Forex and futures. And I've also seen traders succeed in both. Do you want to know which traders succeed in both? Those that have a good, proper trading plan. The traders that follow it, they manage risk, and they don't blame the markets when things go wrong. And the traders who fail, they're just chasing that perfect market. They think switching from Forex to futures will just fix their lack of discipline. But let me tell you, it won't. Switching markets won't fix bad habits. But choosing the right environment can make discipline easier for you. And that's the real lesson here. If Forex spreads, they stress you out, try futures. If futures commissions feel too high, then stick with Forex. If you love the 24-hour access of the Forex market, stay there. If you prefer the clear market hours of futures, just make the switch. It's about the right fit for you. Now, if you're wondering whether you should trade Forex or futures, ask yourself this. Which market helps you stay disciplined? Which one gives you more clarity instead of stress? Which one supports long-term consistency? For me, the answer right now is the futures market. But that doesn't mean it's the right answer for you. And if you want help figuring that out, structure, risk, execution, which market actually fits your trading style, I do offer a mentorship where we look at your situation and see if it makes sense to work together. There's a link in the description to apply for a free call if you want to explore that. No pressure, but here's what I want you to take away from this video. Don't trade what's trending right now. Don't trade what some guru says is better. Trade what fits you. Trade what makes discipline easier. Trade what reduces stress instead of adding it. That's how you build a trading career and not just chase profits. I'll see you guys in the next video.